Hey everyone, before we dive in, here's something really cool. You're listening to an episode created almost entirely by AI. From the script to the voice, this is part of the AI Takeover series by Blockchain DXB, where we explore what's possible when humans hand over the mic to machines. There's little to no human involvement, and that's what makes this episode so powerful. Welcome to the future of content creation. Let's get into it. This episode is powered by Amana, the region's first and fastest growing regulated all-in-one trading and investing app. Whether you're looking to invest in US stocks like Apple or Tesla, or MENA giants like Adinoc or Salik, Amana puts the financial market at your fingertips. You also get access to gold, foreign exchange, ETFs, futures, and commodities. With over 375 assets to choose from, they've got the largest crypto selection in the region. And listen, guys, if you want to build long-term wealth without thinking about it every day and want to automate your investing, just set your monthly budget, choose your preferred categories, and let Amana do the rest. No fees, no lockups, and 100% customizable. Even better, funding your account is frictionless, and funding your account is easier than ever. You can fund your account with Apple Pay, Google Pay, credit cards, instant bank deposits, and even your crypto wallet. No friction, no hassle. And if you get stuck, Amana offers 24/6 real human customer support and personalized sales assistance. Because you're part of the Blockchain DXB community, you get an exclusive offer. Register with the code BlockchainDXB and make at least one trade to receive a $100 trading bonus credited to your account the following month. So what are you waiting for? Download the Amana app now. The link and code are in the show notes. Next up, Blockchain DXB is proud to be the official media partner for one of the biggest blockchain events of the year, the Blockchain Futurist Conference. For the first time ever, North America's leading crypto event is heading to the United States, taking place at the iconic Guitar Hotel at Hard Rock in Hollywood, Florida. Alongside it is ETH Women, happening simultaneously. Expect multi-stage panels, NFT galleries, DeFi showcases, tech demos, metaverse experiences, and more, all under one roof. It's where the smartest minds in blockchain, crypto, and AI will converge. Get 25% off tickets by using the code DXB25. And yes, I'll be there with exclusive live coverage, behind-the-scenes interviews, and spotlight features on groundbreaking projects. Mark your calendars, November 5th and 6th, 2025. Visit futuristconference.com and use code DXB25. Link is in the show notes. Next up, Blockchain DXB has two more interesting partnership news to announce. First up, with Future Blockchain Summit and Fintech Surge 2025. Blockchain DXB is an official media partner of Future Blockchain Summit and Fintech Surge 2025. Future Blockchain Summit is one of the biggest and oldest blockchain summit taking place in Dubai, going back to almost a decade, 2017 to be precise. The event takes place between October 12th to 15th at Dubai Harbour. This is where blockchain meets fintech to redefine the future of finance. 250 plus world-class speakers, 1,200 plus investors, live demos, product launches, and the exclusive invite-only GITEX Digital Assets Forum, all under one roof. From Web3 pioneers to fintech leaders shaping payments, banking, insurtech, AI, and DeFi, this event brings the entire ecosystem together. Startups, this is your launchpad. Get in front of top VCs, accelerators, and industry leaders. For blockchain and fintech companies, this is where connections turn into partnerships and dreams turn into exits. Register today at futureblockchainsummit.com. Don't just watch the future unfold, own your space in it. Remember, Future Blockchain Summit and Fintech Surge 2025. The registration link is in the show notes below, and see you at Dubai Harbour. Second partnership news kicking off from today is with the leading Bitcoin event organizers on this planet. And this year, Bitcoin Asia is taking things to another level. Bitcoin Asia are hosting a massive gathering this August in Hong Kong, and Blockchain DXB is proud to be an official media partner of Bitcoin Asia 2025. Taking place this August in Hong Kong, Bitcoin Asia is the region's premier Bitcoin gathering, where builders, investors, and innovators meet. It's really an honor for Blockchain DXB to be associated with Bitcoin Asia. Now at this event, expect powerful keynotes, bold conversations, and a headlining session with none other than Eric Trump. He will be sharing his vision for Bitcoin's long-term potential, its role in global finance, and Asia's massive impact on adoption, and a lot more. So listen up, guys. From infrastructure to regulation, privacy tools to lightning development, Bitcoin Asia connects global Bitcoin communities and drives innovation across cultures and markets. And as part of this partnership, you can register for the Bitcoin Asia using the code DXB. All the details are in the show notes below. If Bitcoin's in your blood, this is your event. So, register today at asia.btc and don't forget to use code DXB for 10% off your tickets. Bitcoin Asia 2025, Hong Kong is calling. Be part of the future of Bitcoin. Next up, Advanced Media is the largest distributor of professional video, photography, cinema, and broadcast accessories in the Middle East. They represent over 100 major brands, including DJI, Hasselblad, Red, and Rode. The mic I'm using to record this? Sponsored by Advanced Media. But what really sets them apart is their commitment to purpose. People, planet, and prosperity. That's not just branding, it's their actual business model. They've partnered with SAE Institute in Dubai to offer scholarships to students pursuing a bachelor's degree in filmmaking, each worth AED 50,000. They also run regular workshops, training programs, and tech showcases across the region. For more info, visit amt.t, that's amt.tv. Finally, let's talk about something every crypto investor should take seriously: security. And that's where Ledger comes in. Ledger is one of the most trusted names in crypto security. Their hardware wallets, like the Nano S Plus and Nano X, keep your assets safe by storing your private keys offline. That means you're protected against hacks, malware, and phishing attempts that can compromise online wallets. The company is headquartered in Paris and is constantly innovating. Their team works with world-class security researchers and regularly tests their own products for vulnerabilities. It's why Ledger wallets are used by millions around the world. Using a hardware wallet isn't just smart, it's essential. If you're serious about crypto, it's time to stop relying on centralized exchanges or browser wallets. Click the link in the show notes to order your Ledger wallet and support this podcast at the same time.
Welcome back to the Deep Dive, February 16th, 2026. And look, I'm just going to be honest with you, right off the bat. If you were brave enough to open your portfolio app this morning, you might be nursing what we're officially calling a Valentine's Day hangover.
Yeah, it is looking pretty rough out there. A lot of red across the board.
Rough. I'd say rough is a polite way to put it. The market sentiment meter is clocking in at extreme fear. Bitcoin's down, Ethereum is taking a beating. It just feels like the air got let out of the room. But, and this is exactly why we do these deep dives, if you just look at the red numbers and walk away, you are missing this massive, glaring contradiction in the data.
It's a classic signal versus noise problem, you know? The price action is all noise and scary, but the signal underneath is telling a completely different story.
Exactly. Because while the price is dropping and everyone on social media is screaming sell, we're seeing, around $30 million in net inflows into crypto-related ETFs?
Which is the anomaly. I mean, usually when fear spikes, money runs for the exits. That's human psychology 101. But right now we're seeing the smart money, the institutional capital creeping in while the retail crowd panics.
They're buying the dip while everyone else is selling the bottom.
Exactly.
So that's our mission today. We're going to look past the red charts and the panic. We need to figure out why institutions are buying, what the new U.S. inflation data actually means for your wallet and for Bitcoin miners. And then we've got to get into some, serious sci-fi territory.
Oh, yeah. Quantum-proofing the blockchain and AI agents that can pay each other.
Without humans involved. It's wild.
It's a perfect example of how the price is often boring, or in this case, terrifying, while the infrastructure is just quietly advancing at light speed.
Okay, but let's start with the crime scene, though. We mentioned extreme fear. Give us the damage report. What are the charts actually saying right now?
It's a slide. There's no sugarcoating it. Bitcoin is hovering around $68,394. That's down roughly 2% in the last 24 hours. But context matters here. We're way off those highs we saw back in, October of 2025. It feels more like a slow bleed than a sudden crash, which can actually be more draining psychologically.
And the altcoins.
Yeah.
I mean, usually when Bitcoin sneezes.
They catch a cold. They're definitely sick. Ethereum has taken a much harder hit, dropping to about $1,950. That's a slide of roughly 6.5%.
Ouch. Sub $2,000 Ethereum? That's a huge psychological level. When you see that first number change from a 2 to a 1, it just changes the whole mood of the market.
It does. It triggers stop losses. It triggers fear. And looking further down the list, you have Ripple sitting at number 3 in market cap, trading around $1.46. It's technically overtaken Binance Coin, but here's the catch.
The volume.
The volume just isn't there. It's sitting around $5.8 billion in 24-hour volume. For a top 3 asset, that's incredibly thin. It suggests nobody's really trading it. It's just drifting.
Okay, so prices are down, volume is thin on alts. But let's go back to that contradiction. You said $30 million in ETF inflows. If Bitcoin's down 2% and Ethereum is down 6%, why isn't that buying pressure moving the price up?
That's the fascinating disconnect. Historically, there's a really strong correlation. Huge ETF inflows equal a price pump, simple supply and demand. But right now, we are seeing positive inflows, smaller than the massive billions we saw in 24 and 25, but the price just isn't responding.
So someone's selling into that buying pressure.
Exactly. It suggests that while retail investors might be panicking or just staying on the sidelines, institutions are absorbing that sell-off. They're acting as the liquidity sponge. But the inflows aren't aggressive enough to chew through the sell walls just yet.
It feels like the market's just running out of gas.
That's a great analogy. And if we want to check the gas tank, we look at stablecoins. Stablecoins are the dry powder of the crypto world. It's the money sitting on the sidelines, ready to be deployed.
Right, the ammo for the bull market. If I sell my Bitcoin, I usually move into USDT or USDC and wait. So are the tanks full?
They're surprisingly empty, or at least not full enough to start the engine. The 24-hour volume for USDT Tether is sitting around $91 billion. USDC is way down at around $15 billion.
Okay, put that in perspective for me. If we were in a raging, everyone get in here, bull market, what should those numbers look like?
You'd want to see USDT volume closer to, say, $140 billion, maybe even $160 billion. That signals velocity. That signals money moving fast, rotating from cash to crypto and back again. At $91 billion, it tells us that there just isn't enough immediate liquidity to push through. The buyers are there, but they're cautious. They aren't market buying. They're setting limit orders and waiting.
A liquidity crunch, basically.
Yep.
What about where people are trading? We've heard nonstop news about BlackRock partnering with Securitize, Uniswap gaining traction. Are we finally seeing the great migration to decentralized exchanges?
You would think so, right? With the whole ethos of crypto, not your keys, not your coins, that people would be fleeing to DXs. But the data says absolutely not. The ratio of DX volume to centralized exchange volume is currently sitting at about 24.7%.
So for every 4 trades, 3 of them are still happening on a centralized exchange like Coinbase or Binance.
Precisely. Even with trillion-dollar giants like BlackRock signaling interest in DeFi, the vast majority of volume is sticky. It turns out, people like customer support and password resets. We're in a transition, but the death of the CEX is highly exaggerated. It seems convenience still trumps ideology for the average trader.
Okay, so that's the market snapshot. Fear is high, liquidity is low, but the big players are arguably front-running a recovery. But crypto doesn't exist in a vacuum. Let's zoom out to the real economy. We got fresh CPI data, the consumer price index from the U.S. Is inflation finally dead?
The data is actually looking promising for the average American. Overall prices rose just 0.2% in January. If you look at the 12-month picture, inflation is at 2.4%.
And that's down from the previous month.
Correct. It was at 2.7%. So the trend is your friend here. We're seeing a consistent cooling off towards that 2% target the Fed loves so much.
But I always feel like those headline numbers hide the pain. I went to the grocery store yesterday, and it definitely didn't feel like prices were cooling.
And that's because of the breakdown. You're spot on. Food prices are actually up about 2.9%. That's what hits consumer sentiment the hardest, because you buy food every week. But, and this is the key for crypto energy prices, decreased by 0.1%.
Okay, connect the dots for me. Why does a tiny drop in energy matter to a Bitcoin trader?
It matters immensely for the miners. Mining is an arbitrage game. You're turning electricity into digital currency. When energy costs drop, profit margins expand immediately.
So they're spending less to earn the same Bitcoin.
Right. And this is vital because when miners are struggling, when energy is expensive, they have to sell every single Bitcoin they mine just to pay the electric bill. We call that miner capitulation. That creates constant selling pressure. Lower energy costs mean they can afford to hold on to their coins. They become hodlers instead of sellers, which reduces supply.
So cheap energy removes a massive seller from the market. That's bullish. But play devil's advocate here. If inflation is dropping to 2.4%, doesn't that kill the main sales pitch for Bitcoin?
You've just hit on the double-edged sword.
If the dollar isn't burning a hole in my pocket, why do I need a hedge?
Exactly. When inflation is running at 9%, like we saw a few years ago, people rush to Bitcoin as a life raft because the house is on fire. When inflation moderates to 2.4%, that immediate urgency fades. The digital gold narrative becomes less pressing for the average person. It creates a better macro environment for risk assets generally, but it removes that specific panic buy trigger for Bitcoin. It becomes an investment, not a survival strategy.
Speaking of the macro environment, we have to talk politics. The sources mention a massive push for deregulation under the Trump administration. What are we looking at here?
This is significant. We're seeing a move to rescind things like the 2009 endangerment finding regarding emissions. Now, putting the environmental debate aside for a second and just looking at the economics, the estimate suggests this could save consumers around $2,400 per vehicle.
That's real money in people's pockets.
It is. And in economic terms, this creates a risk-on environment. When consumers have more disposable income and corporate profitability rises, that capital has to go somewhere. Historically, it flows into higher risk, higher reward assets.
Like crypto and tech stocks.
Exactly. It signals a business-friendly environment where capital can move freely. However, it's not all green lights. We still have political friction in Washington.
Right, the SAVE Act and the threat of a partial government shutdown. Feels like we deal with this every few months.
It's a recurring drama. The Democrats are pushing back, and there's talk of a partial shutdown, and markets hate uncertainty. So we have this tug of war. Deregulation is pulling the market up, but political gridlock is dragging it down. It creates a chop where the market can't decide which way to break.
A chop. Okay, I want to pivot. We've covered the money, let's cover the code. There's a story buried in the sources about future-proofing Bitcoin that sounds, honestly, a little alarming. We're talking about quantum computing.
This is the topic that keeps cryptographers awake at night.
Break it down simply. Why is a quantum computer a threat to Bitcoin? I thought the blockchain was unhackable.
It's unhackable by today's computers. But here's the math. Bitcoin security relies on the fact that it's super easy to generate a public key from a private key, but mathematically impossible to go the other way. A quantum computer theoretically changes that math. It could calculate that private key in seconds using something called Shor's algorithm.
So if I have your public address, which is on the blockchain for everyone to see, I could drain your wallet.
In a post-quantum world, yes, that is the nightmare scenario. If a powerful enough quantum computer comes online tomorrow, legacy Bitcoin addresses could be vulnerable.
But the sources say there's a solution on the table.
There's a draft proposal. It's a Bitcoin Improvement Proposal, or BIP, specifically draft BIP-360. It introduces a system called P2MR, which stands for Pay Fan to Merkle Root.
Pay to Merkle Root. Okay, without getting us lost in the weeds, how does this stop the quantum computer?
Think of it as it's like an invisibility cloak for your public key. Right now on the blockchain, your public key is often exposed. P2MR works by hashing the key in a way that the quantum computer can't see the target until it's too late.
Hides the target.
Essentially, you reveal the key only at the exact moment you spend it, and by then the transaction's already secured. It allows you to prove you own the coins without revealing the mathematical vulnerability.
Now, I noticed something in the notes. The sources mentioned the creator is a developer named Amri Taku, and there was a note about a connection to the Epstein files.
Yes, that is in the source material. It seems his name appeared in those files. It's obviously a heavy piece of context.
Does that matter for the code? I mean, do we cancel the upgrade because of the author?
In the corporate world, probably. In the world of open source code, not really. The ethos of Bitcoin has always been don't trust, verify. The community doesn't care who wrote the code. They care if the math works. BIP-360 will be judged purely on whether it actually stops a quantum attack, regardless of the author's background. The code stands or falls on its own merit.
And knowing Bitcoin, this isn't happening next week, right?
Absolutely not. And that's a good thing. If a bank wants to upgrade its software, The CEO signs a paper, they push an update on Sunday night. Bitcoin has no CEO. A change this big has to be peer-reviewed, tested, debated, and accepted by tens of thousands of nodes globally. We are talking months, possibly years of testing.
Which brings me to something that is happening fast. We have news that Lightning Labs has released L42. And this sounds like the beginning of the robot uprising.
It's certainly a brave new world. L42 is a suite of tools designed to let artificial intelligence agents interact directly with the Bitcoin Lightning Network.
So we aren't just talking about me buying a coffee, we're talking about my AI buying.
Yeah. Anything it needs to do its job. Imagine you have an AI personal assistant. It needs to access a paid database to answer your question. Right now, it can't. It doesn't have a credit card. It doesn't have a social security number. It's unbanked.
So L42 gives the AI a wallet.
Exactly. It enables machine-to-machine commerce. An AI can now hold a wallet, receive payments for its work, and pay other AIs for services, computation power, storage, data access all, instantly and without a human ever clicking approve. It allows for a fully automated economy running parallel to ours.
That sounds incredible for efficiency. But giving an AI a bank account, even a crypto one, sounds like a security nightmare.
It definitely raises eyebrows. The proponents love it because it's permissionless. You don't need a bank's permission to give an AI money. But the detractors have valid concerns.
Like what?
First, scalability. If billions of AI agents start spamming micropayments back and forth, paying a fraction of a cent every second, can the network actually handle that load? Lightning is fast, but that's a massive stress test.
And what if the AI goes rogue?
That's the security risk. What if an AI hallucinates, as they do, and decides to drain its wallet on something useless, or sends the funds to a burn address? Since there's no bank, there's no undo button. If your AI spends your Bitcoin, it's gone.
And privacy.
That's the big one. If we have massive amounts of machine commerce, data analysts could potentially look at those payment flows and map out the entire network of AI interactions. It could reveal a lot about who's running what models, so while the payment is anonymous, the pattern of behavior might not be.
It's wild to think about. We have robots paying robots, and meanwhile, in the traditional world, we have Donald Trump getting into ETFs.
It is quite the juxtaposition. The Trump Media Technology Group has filed for 2 new crypto ETFs.
And these aren't just generic Bitcoin ETFs, right?
No, and this is where it gets specific. The filings indicate they're linked to Kronos, which is the native token of Crypto.com.
It is a very specific partnership. Why Kronos?
It suggests a deepening tie between the platform and the media group. It's not just about crypto, it's about specific ecosystems. Now, these were filed mid-February, so they're sitting with the SEC waiting for approval.
Are the fees competitive?
Estimated at around 0.5%. It's decent, not the cheapest, but not a ripoff. But the fees aren't the story. The story is the validation. When a major media group, especially one connected to the president, starts launching specific token ETFs, it signals that crypto isn't just a niche asset anymore. It's becoming a standard part of the corporate institutional playbook.
Speaking of institutional playbooks, we have to look east. The Middle East is making some serious moves this week that make the U.S. look a bit slow. First up, the UAE.
This is huge for the institutional side. The Central Bank of the UAE has officially approved the DDSC. It's a dirham-backed stablecoin.
Now, before our listeners go looking for this on Uniswap to trade it, this isn't for us, is it?
No, put your wallets away. This runs on the ADI chain, which is a permission layer 2 blockchain. It is strictly for government and institutional use.
So what does it actually do?
It's for the plumbing of the financial system. Payments, settlements, trade finance. Think of a massive oil deal between 2 countries. Instead of waiting 3 days for SWIFT transfers and dealing with correspondent banks, they can use the DDSC for instant, transparent settlement on a ledger.
It's replacing the SWIFT system with a blockchain, basically.
Exactly. And it's fully backed by dirham reserves, involving major players like First Abu Dhabi Bank. It shows that the UAE isn't just crypto-friendly in a marketing sense. They're building the actual rails for a digital economy.
And just a bit further over in Saudi Arabia, another massive partnership. Saudi Aramco and Microsoft.
The world's largest energy company meets one of the world's largest tech companies. They signed a memorandum of understanding to use industrial AI.
And this is powered by Azure.
Yes. The goal is to optimize energy and chemical operations. They're using AI to analyze vast amounts of industrial data to improve efficiency, reduce costs, and forecast trends.
It's a signal, isn't it? We talk about Web3 and AI as these abstract, futuristic things. But here is Saudi Aramco, the bedrock of the traditional energy economy, saying, we need this tech to survive and thrive.
It is the merger of the old world and the new world. It validates the technology in a way that 1,000 white papers never could.
So let's pull all these threads together. We started this deep dive talking about a Valentine's Day hangover and red charts. But when we look at the pieces, BIP-360 quantum proofing, AI agents on Lightning, institutional stablecoins in the UAE, it doesn't feel like a hangover. It feels like a construction site.
That is the perfect metaphor. The price action is fearful. Retail is scared. But the infrastructure is advancing rapidly. You have the technical layer getting stronger with quantum resistance. You have the utility layer exploding with AI payments. And you have the regulatory and financial layer solidifying with things like the UAE stablecoin and US deregulation.
It's almost like the price is a distraction.
It often is. The market votes on sentiment today, but it votes on reality in the long term. And the reality is that the rails are being laid down right now, regardless of what the price of Ethereum is this morning.
I want to leave our listeners with a thought here. We talked about the speed of these things. Bitcoin takes years to update, like with this new quantum proposal. It's slow, deliberate, bureaucratic almost. But the UAE central bank launched a stablecoin relatively quickly. AI agents transact in milliseconds.
It raises a provocative question about the future speed of finance.
Exactly. As we move toward a world of AI agents paying each other at the speed of light, will the slow, deliberate, consensus-based governance of Bitcoin be its greatest strength? Or will it become a bottleneck?
That's the trillion-dollar question. Is slow and steady a feature or a bug when the rest of the world is moving at warp speed?
Something to chew on while you stare at those red charts. Thanks for diving in with us today. Keep your eyes on the tech, not just the ticker. We'll catch you on the next deep dive.
Goodbye, everyone.